Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks in Asia fall as Chinese inflation turns negative for the first time in more than a year. In the US, markets face another volatile week on growing fears of a recession. Will there be a deal in the desert? President Zelensky heads to Saudi Arabia for talks with the US as Donald Trump says a freeze on intelligence sharing with Ukraine has just about been lifted. Plus, taking the fight to Trump, Mark Carney wins the race to become Canada's next Prime Minister with this message for the US President.
America is not Canada. And Canada never, ever will be part of America in any way, shape, or form.
Good morning, happy Monday. European futures pointing higher then by around, 0.6% after the losses that came through by the end of the week. 3 straight weeks of losses, by the way, for US stocks and a week of losses for European equities, despite the impulse around the fiscal spend on defence, with Germany, of course, at the heart of that story. FTSE 100 futures currently pointing to gains of 26 points here in the UK. S&P futures stateside pointing to losses now, 0.5%. NASDAQ 100 futures also pointing lower by 130 points. The squeeze has been on the tech sector in the US, and that underperformance versus Europe, of course, continues for US stocks. Let's flip the board and have a look cross asset. The moves into treasuries, particularly at the front end on these recession fears in the US. President Trump not pushing back particularly strongly on the expectation from some quarters, at least, that you could be looking at a picture of negative growth potentially in the US in maybe the medium term. 397 right now on the 2-year, below 4%, with yields dropping 2 basis points in the session today on that safe haven tilt and search for protection. Euro dollar at 108 on the single currency, currently unchanged, and Brent below $70 a barrel, 69.92, down 6.2%, and that will be largely pegged, of course, to growing concerns about a slowdown in the global economy, but also inflation out of China remaining and reminding us of the softness when it comes to consumer demand there. Gold as a safe haven move, currently up 0.1% for the yellow metal at 2,910. Let's cross over right now to Singapore. Avril Hong standing by for a check on the Asian markets. Avril.
Yeah, Tom, we're seeing those growth worries not just from China, but also the U.S. weighing on equities in the region. I mean, those cracks in the U.S. labor market, but also China CPI showing it below zero for the first time in more than a year. Clearly, these deflationary pressures persist as the country is facing off with its key trading partners. It's not just about these tariffs on U.S. farm products that have gone into effect today. It's also about how over the weekend it announced these retaliatory tariffs on some Canadian products. So it's very weak in terms of risk appetite in the region, although the Nikkei is a bit of an outlier because of a chip stock rebound. But you're seeing how the renminbi is on the slide, as are Chinese stocks. Now, look at the Chinese tech stocks on the Hang Seng Tech. It shows you how the AI optimism of late is not enough to even offset these deflationary pressures. And this chart, courtesy of MLive's Mark Cranfield, also shows you how that 24,000 level that you saw earlier, we seem to be headed to a close below that today, is a key one to watch, because if you look at the moves from last week, powerful rebound, a bit of a decline today. It looks like a blow-off top pattern is emerging, and if we get confirmation of that at the close today, could be problematic, negative in the short term for Chinese equities, Tom.
Avril Hong in Singapore with a check on the Asian markets and, of course, inflation being a drag broadly across the space there. Thank you, Avril. Now to what we've been hearing from Fed Chair Jay Powell amid, of course, mounting concerns about the health of the US economy. Fed Chair Jerome Powell acknowledging increased uncertainty in the US economic outlook, but he says officials don't need to rush to adjust policy.
While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity.
Well, Bloomberg's Valerie Teitel joins me now for the market reaction to that and, of course, the increased conversation about recession risks in the US. Val, do the markets believe Jay Powell when he says we are in no rush to move?
Well, look, equities staged quite a decent rally on Friday because of the optimism from Powell. He went on to state that the U.S. economy is in a good place. Didn't necessarily mirror the growth risks that have hit the U.S. equity market of late, but we very much ended on a positive footing on Friday. The S&P 500 battling with its 200-day moving average for the first time in a year. We've closed above it, but we did dip below on that Friday session. Powell also had some comments when it comes to inflation. He says he's confident about inflation's trajectory back down to 2%. And on that, guys, we do have U.S. CPI printing on Wednesday. We also get some data on the U.S. consumer. We have Friday, the University of Michigan survey, that a consumer sentiment survey. Maybe some questions out there, and will it mimic these recent concerns, these recent growth concerns on the U.S. economy? Because in the overnight session, Tom, we are risk off. We're seeing a hit to U.S. equity futures, a move into treasuries, and the dollar is a bit stronger as well. So will these growth scare concerns be amplified this week or put to bed? That's the question for the markets.
OK, Bloomberg's Valerie Teitel, thank you very much indeed. Let's stay on this topic, of course, because the US president has waded in as well. US President Donald Trump deflecting concerns about the risks of a US recession. Here's what the president told Fox News.
I hate to predict things like that. There is a period of transition because what we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
OK, opening trade anchor Kriti Gupta joins me now. So a period of transition is what President Trump is talking about when it comes to this U.S. economy.
Carefully worded there, but not unlike what he said on the campaign trail when asked about this very concern that historically tariffs and reciprocal tariffs can take a hit on the economy. You're already seeing those worries baked into things like the jobs report, of course, which Valerie Teitel hit, but also the Beige Book. We've seen elements of this in the past couple of months when it comes to various regions of the country as well. But this is something that Donald Trump is saying this, you basically have to take a spoonful of sugar with your medicine. And then this is important as well because this is one of the biggest criticisms that he's kind of facing in terms of this tariff approach, especially when it comes to the way the stock market is reacting. And it's the volatility, it's that uncertainty and the push and pull that the markets are reacting to. But when it comes to that tariff approach as well, remember he's doing this, or at least has claimed to do this, as a way of getting tax cuts for American citizens and really being able to balance the books of a deficit concern that's looming on the horizon in as early as July. So these are kind of the various pieces. The very first piece, though, to get to those kind of cuts on the other end ultimately comes from tariff revenue.
Is there any sense that kind of the mounting concerns, at least from some quarters, about a slowdown in the U.S. economy, recession risks, stagflation, that any of that is derailing the Trump administration's push on tariffs? Where do we stand on their thinking about how far and how fast to go?
Well, you've definitely seen many corporate lobbyists already kind of at the throat of the White House trying to say pull back on some of this. You see in the auto space, you've even seen it in the pharmaceutical space, and now you're starting to see it in the agricultural space as well. But look, the argument here as well is that this is also coming with a deregulatory government as well. So the idea here is that perhaps you can pull down taxes, you can pull down some of the red tape in exchange for the tariff concerns. But also, so much of the price hikes that a lot of these American citizens have been able to absorb has come from leftover savings as a function of COVID stimulus checks. And that's why you've seen this story of American exceptionalism, a lot of liquidity still baked into the system. If you're not talking about a potentially hawkish Federal Reserve coming down the pike, married with the idea of depleted savings, suddenly consumers aren't going to be able to pay a little bit extra for cars or a little bit extra for food. And that's where the concern lies among the economists. OK, Kriti Gupta, thank you very much indeed. Of course, anchor on the open trade, breaking down what we've been hearing in terms of concerns about the US economy and, of course, from the president himself. To geopolitics right now, and this is one of the factors, of course, tying into concerns around volatility. US and Ukraine negotiators are set to meet in Saudi Arabia tomorrow to discuss a truce with Russia. Ukrainian President Volodymyr Zelensky is also travelling to the kingdom to meet Crown Prince Mohammed bin Salman. This comes as President Trump says he has largely lifted a freeze on US intelligence sharing with Ukraine, as Russia says it is ready to discuss a temporary truce.
I think what's going to happen is Ukraine wants to make a deal because I don't think they have a choice. I also think that Russia wants to make a deal because in a certain different way that only I know, Only I know they have no choice either.
OK, joining me now is Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, what is the latest then as we lead up to these meetings in Saudi Arabia?
Well, yes, we have officials gathering in Saudi Arabia. Obviously, the U.S. is seeking any kind of truce or step toward a ceasefire type agreement. Now, for this meeting, this is a very high-stakes meeting for President Volodymyr Zelensky. He has a fine line to walk. We saw the disastrous Oval Office meeting on Friday. We saw that there's a bit of a hard relationship between the U.S. president and the Ukrainian president. But he needs to make sure that Ukrainian security considerations are still taken into account in any sort of ceasefire deal. So it is a tough line for him to walk, making sure that he still has a seat at the negotiating table and can still engage the U.S. president at a time when their relations are quite fraught. So whether we do see movement towards any kind of ceasefire deal remains to be seen, but that's one of the contours that we'll need to be watching closely at this meeting today.
Greg, clearly we've seen this pressure campaign, haven't we, from the Trump administration, whether it's a dressing down in the Oval Office of Zelensky, whether or not there's the ending of weapons supplies and then intelligence. Trump's saying that he's kind of walked back and some of that intelligence freeze. Is that true? What do we know about that? And the flip side is, where is the pressure on Russia at this point? It seems to be pretty one-sided.
Well, that is a great point. It does seem to be somewhat one-sided. We did hear on Friday that Trump threatened new sanctions on Russia as they continue to, as he said, pound Ukraine. But mostly we've seen the U.S. realign their policy towards Russia, and we haven't seen a significant amount of pressure. Now, we do know from people in Moscow that Russia may be willing to agree to a ceasefire if there is progress towards a final resolution and other certain conditions. But right now, most of the pressure has been on Ukraine to come to the table. And Ukraine is very nervous because they have the most to lose, and they're very worried that their security considerations will not be taken into account in any kind of ceasefire deal if the pressure remains solely on Ukraine and not on Russia, as we have seen so far.
OK, excellent update. Greg Sullivan, thank you very much indeed. A really significant week then, potentially, in terms of the meetings taking place in Saudi Arabia around a possible, of course, tentative ceasefire and maybe some kind of agreement between the US, Russia and Ukraine. Greg, thank you. Here's what else we're thinking about then today in terms of the German economic picture, as, of course, lawmakers there push through and look to push through additional spending. We get German industrial production. That's later today, so we'll break that for you, of course. Continued concern about the trajectory of that economy, but maybe there's a turnaround in the works towards the second half of this year. Staying on the German picture, Volkswagen, they come through with earnings on Tuesday. And then on Wednesday, in terms of the data out of the US, the big one for the week, it is CPI. After jobless claims, of course, on Friday, we get the inflation print on Wednesday. Will we build on concerns about stagflation potentially in the US or put those concerns to bed? So the inflation story getting some colour out of the US on Wednesday. Coming up, we're going to discuss growing concerns about the US economy and the global impact of tariffs with Sonali Rawal from Anand Rathi Wealth. That is coming up next. Stay with us. This is Bloomberg.
Here. We'll see how the earnings stories managed to cut through the macro picture.
Bloomberg is first to break the numbers.
Earnings story coming through from UBS.
Crédit Agricole posting a fourth quarter profit.
Novo Nordisk, LVMH, ASML.
With the smartest insights.
Do you think the price to book number could go higher if Santander was a little bit smaller?
So we are only scratching the surface of our potential as a group.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Now, growing concerns about the health of the US economy are weighing on investors. Tariffs, a higher unemployment rate and federal workforce job cuts, raising the prospect of a slowdown in the world's largest economy. Let's discuss this then and the possible impact on India? With Sonali Rawal, Head of International Business at Anand, Rathi Wealth. Sonali, good morning. Thank you for joining us. Let's start with the story on the US then. Are you and the team starting to price in a US recession at some point this year? How high do you think those risks are right now?
Hi, Tom, and thank you for having me. I think the bit is that we think that the U.S. economy is actually very resilient. There were talks about recession in 2023. That didn't happen. In 2024, there were talks about recession, and that didn't happen. So, the talks about the recession, we don't really think that it's a very big risk factor for 2025. But the big concerns that do remain for the U.S. economy remain the inflation and the fiscal deficit that is mounting. And that will definitely have an impact on India. Having said which, only time will tell. In case the recession does come in, we don't live in a world of isolation, and definitely there will be impact on India. We are already experiencing a lot of the impact of the mounting debt that you see of the US, with rates being the way they are. A lot of flight of capital that has taken place, from the Indian markets to the rest of the world. So a lot of the foreign investors are from the US, and we have already seen an impact of that. But we do believe that is on a reversal trend, and it's near its bottom end.
Okay, Sonali, I mean, as you suggest, look, as an open market, as an open economy, India has to weigh up the impact of the US as well. So what assumptions are you making about the Federal Reserve for the rest of the year in terms of potential cuts that could come through from the Fed? Jay Powell suggesting that they're in no rush at this point.
Yeah, so if the cuts come in, again, that will be good for India because then we can see, again, the flight of capital that has gone out actually coming back into India, because India has got growth prospects, long-term growth prospects, and our fundamentals do remain very strong. So it has been temporary that the money has gone out because rates have been good outside, and also the foreign investors do follow a certain pattern. Right? They look at booking profits, wanting to buy low and exit high. So a lot of it has taken place in October, where the Indian markets were quite high. However, if the Fed rates remain where it is, or if the debt pressures increase, inflation pressures come back, which is possible with all of the tariffs that are going on, then we wouldn't see the Fed rates coming down. And if that continues to be up, then that could be a potential risk for India. The other bit that we are... Yeah.
Sonali, I just want to get on the tariff and trade part. What is the tariff risk for India, and to what extent is that priced in? The Nifty 50 is down, 13-14% since September. To what extent is the tariff risk part of that story?
So the tariff risk, I think definitely it is a big risk for us because US is one of our largest trade partners. We have a trade surplus of about $77 billion with the US, and it is to some extent it has been accounted for, because if you look at the fiscal deficit target that the Finance Minister Nirmala Sitharaman has given, it's been about a 4.4%. We were expecting at Anand Rathi, honestly, it to be a little bit more, to be lower. So some amount of risk has been built in, but if the tariffs do come in, we will see the fiscal deficit going up. But we have been in a comfortable position on the fiscal debt. So even if it does go up a little bit, we are still in a strong position in terms of our macro fundamentals. But we will see impact of the tariffs coming in, because those industries will have to be fueled by the government with the increased tariffs that we would see. Having said which, I think India is very open to having negotiations and looking at trade agreements. They have renegotiated rates with UAE in the past, Norway, Switzerland. They are in talks of those trades with Europe and UK as well. So, I think Prime Minister Modi has always had a very diplomatic approach on this, and not just going out on a upright trade.
OK, yeah, and certainly we know that they have a strong relationship, don't they, between the leaders of both countries. We'll see if that holds up amid these tariff risks. So, Sonali, Rawal, thank you very much indeed. Head of International Business at Anand, Rathi Wealth. We appreciate it. Coming up, European gas prices fall from record highs, but now the industry faces the challenge of storing enough gas for next winter. We have the details coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, in just 7 years, the US has elevated itself from an irrelevant supplier of liquefied natural gas, to the world's largest, giving Donald Trump unprecedented leverage. And we've seen him trying to put that to play, of course. Production capacity is expected to soar another 60% in the first half of Donald Trump's presidency. Here in Europe, gas prices have fallen to their lowest in 5 months as the US presses for a quick ceasefire in Ukraine. The industry will soon turn its focus to restocking supplies over the summer. Bloomberg NEF analyst Olympe Mate joins me now to discuss the trends, has the insights and the analysis. How are gas supplies? Good morning. How are gas supplies looking at the moment then?
Good morning, and thank you for having me. Yes, actually, if you look at the average over the past few years, our storage levels are standing at 37% at the moment, and that's actually not too far from, pre-energy crisis levels on average. But in the past 2 years, since there had been a lot of supply anxiety surrounding refilling stockpiles due to, the uncertainty surrounding Russian flows, the markets have made sure to keep the supplies at a higher level by the end of the winter. And so that's why the market is a little bit anxious at the moment about the current level.
Yeah, OK. So top line historically, not below average, 37%. But given the context around our shortage of gas coming through from Russia, 37%, I mean, to me, it sounds pretty concerning. But historically, you're suggesting that it's not a massive outlier. What is happening when it comes to prices then?
Yeah, absolutely. So as you were saying, prices have come down a little bit since their peak back at the beginning of the year. And that's mostly due to the fact that, at the end of last year, we faced a few challenges surrounding, gas consumption, such as windless weather that boosted a little bit gas to power generation. There was also a little bit colder weather compared to the previous year. And we had a complete halt in Russian flows from the east at the end of 2024. So all of those combined had made prices surge. But most recently, given the milder weather, we've seen a little bit less withdrawals from storage. And I think this has kind of reassured the market a little bit. OK. What then, and I'll kind of push you on this then, what is the outlook for prices through the rest of this year and into 2026? How much clarity do you have or transparency do you have right now around forward-looking pricing? So one very interesting phenomenon that's playing out at the moment is that we're seeing an inverted forward curve for gas prices in Europe. And what I mean by this is that ever since November last year, we're seeing the summer prices in 2025 being higher than the winter prices for the following winter. And that's very unusual because winter is a peak season for gas consumption, right? And the reason behind this is entirely policy-driven. So the European Commission has set storage targets by the 1st of November up to 90%. Those storage targets could be readjusted at some point in the future. But given that hard target at the moment, the markets are making sure that they refill storage throughout summer and not during the winter. OK, so that explains the inversion that we're seeing in terms of the pricing. Olympe, thank you very much indeed for some fantastic analysis. The importance, of course, of how to think about the gas markets in Europe. Bloomberg NEF analyst Olympe Mate. Coming up, Mark Carney wins the race to become Canada's next Prime Minister, taking over amid the country's escalating trade spat with the US. He's not pulling his punches on Trump. Stay with us for that story next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Stocks in Asia fall as Chinese inflation turns negative for the first time in more than a year. In the US, markets face another volatile week on growing fears of a recession. Will there be a deal in the desert? President Zelensky heads to Saudi Arabia for talks with the US as Donald Trump says a freeze on intelligence sharing with Ukraine has just about been lifted. Plus, taking the fight to Trump, Mark Carney wins the race to become Canada's next Prime Minister with this message for the US President.
America is not Canada. And Canada never, ever will be part of America in any way, shape, or form.
Well, let's check in on European futures right now. Pushing higher, up 0.7% after a week of losses, despite, of course, the announcement around more fiscal spending coming through from Germany. We continue to focus, of course, on the Bund markets, given the sell-off that was pronounced last week as well. Bund futures pointing lower so far in the session. FTSE 100 futures here in the UK currently pointing higher by 27 points. S&P futures stateside, though, in negative territory, down by 27 points, pointing to losses of 0.5%. 3 straight weeks of losses for US stocks right now, and the divergence with Europe continues so far today. Nasdaq 100 futures pointing low by 119 points. Let's flip the board and have a look cross asset. You've seen moves into the front end of the Treasury curve. The 2-year yields down 25 basis points or thereabouts since the start of the year. Yields down again today in the session on the front end, down 2 basis points at 3.98, back below 4%. 108 on euro dollar, up 0.1% for the single currency. Brent back below $70 a barrel. The concerns around potential US recession risks. Softer data out of China as well on inflation. Weighing on oil, 69.95 right now, down 0.6%. And a bit of a move into hedge that is gold. Currently, the yellow metal up at up 0.1% at 2,911. Let's get to the politics of Canada, because the former Bank of Canada and Bank of England governor, of course, Mark Carney, has won the race to become Canada's next Prime Minister. The transfer of power from Justin Trudeau is expected to take place within days. Carney says retaliatory levies against the US will stay until President Trump drops tariffs.
The Canadian government has rightly retaliated and is rightly retaliating with our own tariffs that will have maximum impact in the United States and minimum impact here in Canada. And my government will keep our tariffs on until the Americans show us respect.
Until the Americans show us respect. We're joined now by Bloomberg's Bill Ferries. And Bill, Carney already striking a defiant tone when it comes to US tariffs. Let's take a listen to what he had to say, Carney, around the positioning on the pressure that is coming through from Trump.
We didn't ask for this fight. We didn't ask for this fight. But Canadians are always ready when someone else drops the gloves. So the Americans, they should make no mistake, in trade as in hockey, Canada will win.
All right, there you go. You heard it from Carney, the incoming Prime Minister of Canada, of course, on the gloves coming off potentially in that spat with the US. How well positioned, Bill, is Carney for this challenge when it comes to Canadian-US relations?
Yeah, a lot of tough talk there. Listen, he comes with an impressive resume. He was at the Bank of England during the Brexit process, and he was at the Bank of Canada leading it during the global financial crisis. So I think if you're looking for someone with a resume of dealing with economic crises, I think he has a lot of that background. Of course, he also has to figure out some time to call elections. So, you know, whether he stays in office or not is going to be up to the Canadian people. But he is someone who has dealt with very turbulent economic times, and I think his language there suggests that this difficult situation with the United States could last a long time.
So, Bill, look, he had this landslide, of course, within the Liberal Party. This could end up being, though, one of the short-lived premierships if they don't win the election, or it could be this remarkable turnaround. How are we thinking about the election prospects right now of Carney?
Yeah, well, I think the Liberals in general were not looking so good a couple months ago when you started seeing the cabinet resignations and the pressure on Trudeau to step down. I think there was a sense that maybe the Liberals were on the back foot. Perhaps ironically, this fight with Donald Trump has reinvigorated them to some degree, so that they are definitely seeing their chances improve. If Carney, the big question for him is when to call elections, because that would involve a caretaker government for a time being. Of course, U.S. tariffs set to come on in early April. So the question is, do you do that right away and then hold the election 35, 40 days later, or do you wait to try to work your way through this with the U.S. administration and then set to have elections after you get through this process? But I do think it looks like a long-standing contentious period between the U.S. and Canada going forward.
Yeah, whoever is the Prime Minister, as you suggest. Bloomberg's Bill Ferries, thank you very much indeed with the analysis on the back of that Liberal Party of Canada's decision, of course, to elect Mark Carney to lead their party and ultimately, in the days ahead, to become the Canadian Prime Minister. Now, some of the stories making the news this Monday. Syria's interim government has formed a committee to investigate violence in several cities. Authorities say clashes erupted on Thursday when armed men affiliated with the ousted regime attacked multiple security sites. The Syrian Observatory for Human Rights says the overall death toll in 3 days has reached more than 1,300. In Romania, that country has banned far-right candidate Călin Georgescu from its presidential election, triggering street protests and risking the wrath of the Trump administration. Georgescu called the decision an attack on, quote, democracy worldwide. His cause has been taken up by President Trump's team. Georgescu has 24 hours to appeal to the Constitutional Court, which cancelled his victory in the previous vote in December. President Donald Trump says he is negotiating with 4 different possible buyers for TikTok's business in the US and that a deal for the social video app could come, quote, soon. He did not specify the contenders nor say which way he was leaning. TikTok faces an April deadline to strike a deal for its US operations or be banned from the country under a bipartisan law passed last year. And Germany's Conservatives and the Social Democrats have agreed to deepen talks over forming a new government. That's as pressure builds on Chancellor-in-waiting Friedrich Merz to implement sweeping reforms. If they fail to bridge their differences, the door to right-wing populists will open wider, risking a rupture with the rest of Europe. Let's bring in Bloomberg Germany editor Chris Reiter then, who recently published a book called Broken Republic. Chris, how far are we from an agreement on a new government? How much progress has been made in recent weeks since, of course, the election in Germany? How much progress towards a coalition?
Yeah, hi, Tom. So on Saturday, they agreed to go what's called to coalition negotiations from exploratory talks. So it's a procedural step. It was largely expected because it's the only centrist coalition option available. So they took that step a little bit faster than expected. So, I mean, that's a good sign on its own. But what happens next, the coalition negotiations are really probably weeks, and those can be very contentious as the parties get down to the nitty-gritty of actually what the policies look like, what does the government program look like. So that it's still weeks away before there's actually a working government in Germany.
Still weeks away. And in parallel, though, they're pushing through policy, or they hope to push through policy in the current parliament before the Bundestag changes, of course. And part of that will be the massive spending on infrastructure and defence. Is that going to get across the line? How much confidence should we have that that gets through? And is that the turnaround, do you think, that this country needs?
Yeah. I think that's going to be a critical moment for this new government, because basically they're looking to the old parliament to fund the program of the new parliament. And also they're going right now, they have like a very narrow window to pass the spending package, because if they don't do it now under the old parliament, the conditions change under the new parliament, where the far-right AfD, which is like intending on blocking these things, and the spending package and then special session of parliament, which is going to come within the next couple weeks, is going to face legal challenges. That's already certain. So But right now we've seen already this weekend that the Greens are very skeptical, and Merz and the SPD need the Greens in order to get the spending package through. So they've already started to ratchet up the price for their support, and it's going to be a tense couple weeks. I mean, I think at the end of the day, because Germany needs this money, they've underspent for decades. That's sort of been widely accepted among the mainstream that they need to do something, and the scale of this package is a bazooka, as they like to say in Germany sometimes. And so, the Greens, it'll eventually, it's likely to go through, but there'll be a lot of tensions, before that happens.
Okay, and the Greens trying to extract whatever they can before that point, it seems. Yeah. Look, as you've documented, Chris, Germany, of course, has been in and out of crisis for the last 20 years. What makes this period, do you think, stand out? What makes this period different?
I think we've seen that just in the federal election alone. So there were 7 parties competing for seats in parliament, and that hasn't been the case in Germany in the past 20 years, 70 years. There was generally political stability, even during the time of when Germany was the sick man of Europe, around Schroeder, around 2000, the early 2000s. That was still dominated by the centrist party of the CDU and the SPD. And now we've seen this in this election that the SPD has fallen to 3rd place. The far right is in 2nd place. And the fragmentation creates political risks of coalitions like we're seeing now, and like we saw in the Schulz government, of coalitions finding it difficult to push through the reforms that the country needs and to actually rally the country together. And that's sort of the different conditions of this crisis versus crises that Germany has faced in the past.
OK, and we watch to see if Germany now and its new government can meet this moment. Bloomberg Germany editor Chris Reiter with fantastic context. Thank you for the details there, as well as the two main parties, of course, continue their talks around a potential coalition, the CDU and the SPD. Now, almost all of Germany's airports face disruption today because of a strike by the labour union Verdi. Ground personnel, baggage handlers and security staff have all been urged to walk out as they demand higher pay and more holiday. So check your flights if you're flying into or out of Germany today. Coming up, we're going to discuss the future of AI with the co-founder of Poolside. It's a startup building artificial intelligence software for programmers. It's raised hundreds of millions of dollars and is backed by the likes of NVIDIA. That conversation is coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, top AI developers have made artificial general intelligence their main goal, raising billions of dollars to achieve it. The term AGI referring to artificial intelligence that can perform as well or better than humans on most tasks, though, of course, the definition is relatively fluid. The software industry could be the first step in terms of revolutionizing or being revolutionized by AI and AI of these capabilities. Let's discuss this again with Eiso Kant, the co-founder of frontier AI company Poolside, which claims to be building the next generation AI for software engineering with a big footprint in Europe. It's a US company with a big footprint in Europe. They've raised hundreds of millions of dollars from backers, including Bain Capital and NVIDIA, with a valuation of around $3 billion. Eiso, thank you very much for joining us from Paris this morning. We appreciate you taking the time. Talk to us about the product that you're building. What kind of demand that you see going forward? How big is this potential market when it comes to developing models that can provide app developers or software developers these AI capabilities?
Hi, Tom. Good morning. The way that we look at this is that we're living in a world where right now AI is starting to drive 20-30% productivity gains for software developers. If you look at the world, there's over 100 million professional software developers. That quickly adds up. But the opportunity here is that in the coming years, we see the gap between human capabilities and AI entirely close. And then really the sky is the limit. What's the actual limit of number of software developers that the world would like to have to build software? Our view is that that's an incredibly large market.
Okay, an incredibly large market. Who are your kind of main clients, or who are you hoping to lock in as clients? Which parts of this economy are best placed to be the clients of Poolside AI going forward?
So our focus has been on enterprises. We today operate in defense, in GSIs, financial service institutions, really organizations that in many cases are anywhere between 5,000 and 100,000 developers. 70% of the world's software developers sit today in large enterprises, and it's where a lot of the economic growth gets driven from, and that's been our focus since day zero.
How do you compete then? What is the moat that you're building out? What is the proposition at Poolside AI versus, for example, Microsoft's Copilot or some of the products being pushed out by OpenAI? What makes you distinguished from your competitors?
So first and foremost, in our industry, I think the number one moat is the capabilities of your artificial intelligence. Essentially, how smart are your models? And so we really focus on building the world's most capable and smartest models in the area of building software and assisting developers today in building software. But it's not just the model. When we work in these complex enterprise environments, it's really our goal to provide not just a model, but an entire system that runs behind their firewall that allows the application experiences and the data layer in between in these enterprises to really materialize. And so while others are general purpose models trying to serve everyone, we really focus on serving software engineering in the world.
And Eiso, you have views. I mean, this is the kind of perennial question that you put to those building these kind of models, these kind of foundation models, which is around artificial general intelligence. It's clearly the key driving goal of OpenAI, of DeepMind over at Google, of course, as well. What is your understanding? What is your best bet as to when we get to artificial general intelligence, however you define that?
So let's start with the definition. I think the first definition we should use here is human-level capabilities across the vast majority of knowledge work that, frankly, we do behind a laptop. Our work essentially in the world of bits. And if you would have asked me this 2 years ago, I would have given you a 5 to 10 year horizon, which is essentially founders speak to. We know it's going to happen, but we don't know exactly when. You ask me today, I believe before the end of 27, so in less than 36 months, we are going to find ourselves in a world where we reach human-level capabilities across the vast majority of knowledge work, and in our view, in software engineering and software development first.
Okay, that's it's a rapid time frame. So what impact does that have then on your clients? What impact does that have on industry? What impact does that have on the economy?
So I think at a very high level, we should try to anthropomorphize the problem and look at this as adding to our workforce. If we are making incredibly capable intelligence that scales on compute, we should be seeing this as where the world today is 100 million developers. It's now going to be capable of having 500 million or 1 billion, really only limited at the bottleneck of energy and chips underneath. And of course, when you're adding so much supply to a workforce, it does two things. On one hand, it's Jevons paradox. We're going to be able to build a vast amount more of software and automation in the world, in our view, driving the cost of goods and services increasingly down to zero and pushing the frontier of scientific research. And on the other hand, it opens up questions for the world that it needs to answer, because when you're adding this much supply, it does come with a shadow at the same time.
What is the shadow, Eiso?
I think, economics 101, when we're adding supply to a market far too rapidly before it can actually absorb it, is that we might see a world where we're going to have to talk about doing a soft landing of AGI so that we are not actually decimating, frankly, our white-collar workforce and our knowledge workforce. And so our view is that this technology should be landing in a careful way, and not as a shock to the system.
Okay, we'll watch to see how it's absorbed, of course, within that relatively short time frame that you're outlining around AGI. Just briefly before we let you go, Eiso, on the funding front, reports that you're looking, or you have raised $500 million in your latest round. You've got some really big backers in terms of Bain Capital, Nvidia, and many others, of course, in terms of signing checks for you and for the company. Where are you on funding at this point and the valuation of the business?
So, as you mentioned, till date, we raised over $600 million to get to where we are today. The vast majority of capital in our business goes to compute, increasingly larger training clusters to increasingly build more capable AI. And in our future, we will have to find ourselves and continue to kind of scale a compute on which we train models. But as of today, we're not in the market out fundraising.
Okay. Putting that money to work around the compute and, of course, building out those clusters as well. Poolside co-founder Eiso Kant, thank you very much indeed. Appreciate you taking the time, joining us out of Paris. Now, staying on tech, with a focus, of course, on AI still, we're around TSMC's revenue. Of course, a big chunk of that coming from these AI chips that they're churning out, climbing 39% in the first 2 months, driven by resilient demand from and for NVIDIA chips that, of course, have powered that AI frenzy. The world's largest chip maker seeing sales serve as a barometer for the sector. However, TSMC faces uncertainty this year, including the potential for US tariffs on chip imports, which could impact its business. Plenty more coming up. Stay with us. This is Bloomberg.
The next payroll sprint is going to look a lot uglier than this one. So, yes, we can't really have a sigh of relief as a result of today's data because we're going to start getting hit pretty significantly.
All the consensus trades at the beginning of the year have been upended. Every single one of them. Currency, rates, relative U.S. equity performance to the rest of the world.
Nothing here that screams recession and at the same time, no broad-based job destruction quite yet.
We're just bouncing around in this range, waiting to see which plays out first. The inflation plays out first or the slowdown plays out first. Right now, it looks like the slowdown.
The real risk here is that you have sentiment that deteriorates that results in a more meaningful for slowing. And I think the Fed would definitely be very attuned to that.
OK, recent guests reacting to the latest US jobs report, which dropped on Friday. Of course, you had a print of 151,000 for the most recent month in terms of non-farm payrolls. You had the unemployment rate moving slightly higher than the estimates, 4.1%. The headlines, though, belying some of the pressure that's coming through below the headline level. That is according to Bloomberg Economics in terms of some of the cooling, some of the softness around that labour market. And you saw that being discussed, of course, in that round of soundbites. Pushing ahead, is this labour market in the US going to start to deteriorate at a more rapid pace? Here's what happens when it comes to the federal jobs picture. Of course, Doge coming through and cutting jobs at a pretty unprecedented rate across the federal government. We've moved on from that chart, but you saw a spike, the highest level in terms of unemployment claims coming from that part of the workforce in about 3 years. This is all building into the case that some are pushing now that you're going to be looking potentially at a US recession. The recession risks starting to tick up. Odds now for a US recession in the third quarter rising. And that is the alarm bells, of course, for many investors out there as they sit on the sidelines at the very least when it comes to the US equity story. Let's flip the bar board and have a look at terms of what is happening in the Chinese markets, because this weighed on Asian stocks today. CPI coming through, consumer prices dropping again. The consumer remains under pressure. The real estate crisis in China has still not been fully addressed. We have inflation out of the US on Wednesday, of course, but the story out of China is not comforting. Stay with us. The opening trade is up next. This is Bloomberg.